To kick things off. Um, Thank you everybody for joining us today for the Exit Advisors Small Business Town Hall series. I do see a lot of familiar faces, so you've probably heard my spiel a few times. Real quick before we kick things off, if you have questions, feel free to raise your hand. You can use the hand raising tool, and we'll, if it's appropriate, we'll call on you during the presentation. If not, we can wait till the end. We've got the Q&A feature at the bottom. This is going to be a really great topic, a little bit of a continuation from what Al was doing last week. We've got Herb Kalman this week, and he's going to walk us through kind of the seller due diligence process. And a lot of you may have heard us kind of rambling before, but Exit Advisors, many of you have already heard this. We are the M&A advisory group within the deal process. So when a small business or medium-sized business wants to sell and go to market, or even possibly make an acquisition of their own and grow, we're kind of the forefront of that transaction. But it doesn't just end there with the transaction. We're not just getting you through the due diligence process that we're going to be discussing today. It's everything that leads up to the due diligence. It's getting you ready to go through due diligence with the buyer. It is the succession planning that you need to go through to prepare for, what do you do with this bucket of money that you have once you sell? How do you safeguard it from taxes? How do you, protect it? So there's just a lot that leads up to it. And most importantly, how do you increase the value? How do you increase the size of that bucket of money when you do go to market? That's where we come in. That's what we do. And that's how we're different than most other banks. It's not just the transaction for us. Anyways, I'm going to pass it over to Gary, who's going to do a little bit more of a deeper introduction to Herb, who the two of them have worked together in the past and I think have a very strong relationship and a great business relationship. So Gary, why don't you take over?
Good afternoon, everybody. Really glad to have you back. I think this is going to be a very informative town hall. I've known Herb now basically since I moved to Houston about 15 years. And I met him after I got my CBA, being a valuation analyst. Herb actually spoke at, I guess you would call my graduation. I don't know what it would have been, but I was very impressed with him. And we spoke afterwards and built a relationship and worked together on some projects. And Herb has got a lot of great enthusiasm about what he does, valuing businesses, getting involved in transactions. He just very, very enthusiastic, and it comes from 50 years of experience, man, as a CPA and with two national firms. He also built some firms that actually ended up selling to national firms. So he's got vast experience in the world of being a CPA and a CVA. He has credentials as a CVA and ABV and CFF. Now, a lot of this has to do with the valuation world, and he's a mastermind as far as ESOP valuations. So, which is a very, very technical area when it comes to the valuation world. He's now retired, lucky guy. I guess he gets to go fishing and play some golf and do things that all of us don't get to do. But I think, he is going to give a very enlightening presentation today. I'm glad you're here. Sell side due diligence is critical and securing really a positive transaction for all parties. So Herb, I'm going to pass the baton to you and make it happen, man.
Okay, thank you. I guess maybe you ought to just give your disclaimer here, or I guess everybody can see the disclaimer. Or I guess, no, that's an advertising piece. I have a disclaimer. So anyway, I have a disclaimer. And just to say that this is not intended as tax and legal advice, and anybody that's reading it needs to talk to a counsel. But thanks for the introduction. Gary, yeah, we did have some interesting projects we worked on together, and I have had a fun career. The valuation business has been a lot of fun, And I think more than anything, I've enjoyed that, although I've done quite a bit of different types of work. Here is my contact information. So I've got the seller due diligence concept broken into 3 areas, which is appropriate for today, Veterans Day. I don't know if we have any veterans out there, but I promise you, if we had somebody who went through Army basic training, they learned about ready, aim, and fire. And so those are our 3 areas that we're going to discuss. You know, in ready, when you're dealing with an exit or with a business owner who's considering an exit, there's a lot of personal issues that have to be put on the table. First of all, succession is not a dirty word. I mean, at some point, the business is going to change hands, and they have to understand that. As Gary said, I'm retired. I got to tell you, it's strange for me because I'm not tired, and I would like to have continued, but it for our firm, with a national firm coming in and me being several years past their mandatory retirement age and not really knowing the people, I just didn't feel like there was a place for me. I probably could have continued to work with them, but I just didn't want to. So I had to ask myself the question that is one of the questions that you have to ask your clients when you have an opportunity. And what does retirement mean to you? Do you need to stay involved in the business? Do you want to stay involved in the business? And if you do, well, that's going to be a different type of a buyer than if you don't mind just disappearing. You know, I had a client one time that sold, and there were some problems, as they are many times. And we worked over the weekend with the buyer. The buyer was a New York Stock Exchange company, and the seller was pretty good sized company in Houston. They were the market leader in Houston in their business. And so we solved everything on Sunday, and we come in on Monday morning, and he being the owner, he was there. He was not involved in the weekend business. His son, who owned a minority interest, was involved. But we were talking, and the phone rang, and he picked up the phone, and he says, okay. And he hangs up. He says, okay, the 2 wires cleared. Thank you very much. And he walked out of the room. He came back in for a second, and some big old guy walks into his office. We were in a conference room that was next to his office, picked up 2 boxes, took them out, put them in his car, and this gentleman walked out, left, and I'll promise you, he didn't look in the rearview mirror. He was done. And that's great if you want that, but you have to find a buyer that will let you leave. There's family issues and outsider issues. For some people who want to stay involved and they want some of the family to be involved, remember, you have a new owner. So how is all that going to work? And that's something they have to understand. You know, the other half of it is, if you're selling the business, what are you going to do after? Because, as I said, that dictates the type of buyer you should be looking for. Will you have enough money? Well, you know, that's part of what y'all are talking about when you're talking to clients. I think I was talking to Andrew earlier, and I think he said that, or well, I guess when he made the introduction, that y'all also have people that are money managers that you can work with, or that your clients work with. And that's important to make sure that everybody understands what's going to happen post-transaction. But the other part of it is, and people don't think about initially, will your heirs have enough money? If they need to have enough money, you know, they could be people that have been able to create careers on their own, or if they work for the company, are they going to have a job post-transaction? And that has to be considered again while you're when you're negotiating, choosing a buyer and negotiating. And then there's gift planning and estate planning, much of which should have been done, but some of which can be done, you know, at transaction. Obviously, if you're getting a big liquidity event and you have charitable contributions that you'd like to make, there's tax advantages to transferring that stock immediately before the transaction. There's risk to that too, but this isn't a tax planning discussion, but it's it's something to think about. So what are you selling? I just sold a house last week. Thank you very much. And when we had moved, but we hadn't, we were ready to move, but we weren't ready to sell the house in a bad market. So, but what do you do when you sell the house? You start out by cleaning it up, painting the house, making it look good so that you can attract the appropriate buyer. With a company, there's not much difference. You still have to clean it up. You have to make it look good. What I've experienced in my accounting career is there's a couple of types of companies, and then of course everything in between. But one is the lifestyle company, where the company just the owners just live out of the business. You just have no idea what the financial statements are going to look like or what type of problems are going to be in there. And then you'll see other companies that are running the business as if they were running it for a third party, and they separate the business from their personal life. And their concept or their purpose in the business is to grow value. You need to look at the financial statements, and the financial statements should be GAAP financial statements, hopefully an audit. But they should keep their financial statements to show the best picture of the company. So I call it financial statements for value, as opposed to financial statements for taxes. Remove extraneous assets. Hopefully somebody's come to you a few years before they're ready for a transaction, and you have the chance then to get rid of assets. For example, there might be real estate in the business that doesn't really belong in the business. It's not going to be transferred to the buyer. Get rid of it now. Yes, there's going to be a cost to do it, but that cost is going to happen at some point in the future. Make it simpler for the buyer to buy a clean business. Make sure you're in compliance with all the issues that affect today's businesses. If it's a good company, already clean, add good corporate governance to it. All of the things you're trying to do is de-risk the situation for the buyer. So, do you have partners? Or what if you have partners, I should say? Hopefully you've got good documentation of what's going to happen. There should be a buy-sell agreement. Things in the buy-sell agreement, I suspect that much of it, it would be pricing, how to determine the price, what the terms would be, making sure that, well, why do you want one, I should ask, and that is it avoids an unplanned sale, which could create a liquidation. But some of the things you would have in there is requiring the non-operating spouse to sell his or her interest to the operating spouse. That means if there's a divorce, then the operators get to stay in control. So that's very important to make sure is in the buy-sell agreement. I'm sorry, I moved on. Also, you may wish to sell to your co-owner. There are a lot of good reasons for it. There's less business disruption, right? You don't have new people coming in. It's easier to plan, and you have a better chance of getting paid. And that's really what it's all about. The form of the transaction, generally buyers want to buy assets, sellers want to sell stock because of tax reasons. Obviously, the seller wants to get the most money after taxes than he can, And so you need to have them in a situation, if it's possible, where they can sell assets and pay one tax. There could also be trust or an estate that has ownership, and you would need to see whether there's issues there that could create problems. And one opportunity that I did a lot of work with was ESOPs, and ESOPs is an employee stock ownership plan. I don't know if anybody's familiar with them, but the short story is it's the business owner sells stock to a trust for the benefit of the employees, and it's allocated to the employees over time. And there's some real benefits, tax benefits there that can be considered, and it's an option that should be considered if the situation is right. I have on here minority family control issues. If you have a company that's not a first generation company, and there's already second or third generation owners, it makes it very difficult if there's not a buy sell, and it can make it difficult with a buy sell. So you need to be real careful on the buy sell agreements, especially as these companies move from generation to generation. By the way, if somebody has questions, just ask me. I don't know that I'll see the hand being raised, but somebody can interrupt. So I talked a little bit about tax issues. If a corporation that's a C corp sells its assets, then there's a tax within the inside the corporation, and when the money is liquidated, the seller has to pay a second tax. If it's an S corp, obviously they can sell assets, and the buyer gets the benefit of the step up in basis, and the seller still gets capital gain where it's appropriate. There's especially in Houston, we've seen a lot of transactions where the seller is an S corp, and the buyer wants to buy has to buy corporate stock because of contracts, leases, master service agreements, those types of things. And there's an ability for the buyer and the seller to agree that the buyer is going to sell the corporate stock, but the buyer and the seller are able to treat it as an asset sale. So just something you have to deal with when transactions occur. There's real estate used in the business, and how is that going to transfer? And by the way, if you can, you should get it out if you don't want it to transfer with the business. And if you have any real estate that is not being used in the business. There could be some difficult tax positions that could create problems and an inability to sell. For example, a couple that I've seen, something that appears to be a real problem now. I don't know if any of you or how many of you have dealt with insurance companies, captive insurance companies. But there's about 2 or 3 years ago, the Internal Revenue Service declared war on on captive insurance companies that were used as abusive tax shelters. And, one would think that they're going to go after the captive insurance company, but they didn't. They went after the actual company by denying tax deductions. So if there's a captive insurance company involved in it, you could certainly, it could create a situation where there's not going to be a sale, or certainly a buyer would say there's too much risk and just walk away. The strangest tax position that created a problem was there was a tax shelter being sold a number of years ago where the business owner would see if I can remember it, but they would sell assets. The business would sell assets to family members, and the corporation would lease them back, but the corporation would be paid by private annuity that would occur when the seller retires, and then the seller would have some type of long-term payout at that time too. Well, we had a client that was looking to sell, and that came up, and the buyer said, "We're done. We don't know how to deal with it. We know that if the IRS comes in, it's a problem, and it's not going to be our problem." So if you have some strange tax positions, you need to try to clean them up in advance, and because the buyer just shouldn't have to deal with it and won't want to deal with it. Sales taxes used to be a problem. Now they're a nightmare. They used to be a problem because the sales tax liability, if you're handling it incorrectly, would typically follow the assets. Now you have reps and warranties, of course, that pay for it. But if it's a mess, then the buyer has to take care of it, and buyers don't want to take care of it. It's a nightmare now because of the Wayfair decision, and we've seen companies that over the last year that are just getting around to dealing with the issue of selling by internet and selling out of state and not filing in those states. So that's some other things that need to be cleaned up. Okay. So anybody have questions on what we talked about here?
Herb, I think Dave had a question, and if Gary's free, I think he'll be really integral in chiming in on this, because
Okay.
it's a topic we've discussed. For a startup that's thinking ahead to exit, maybe 10 or 20 years down the road, can you speak to the exit implications of setting up a small business as an LLC versus a C Corp? And you guys might want to discuss the whole 1202C exemption. That's almost an entire town hall within itself.
Right. Gary, do you want to respond? You want me to respond first?
I'll let you tee it up, and I'll kick in if I need to.
Okay. You'll clean up. You'll clean up for me.
There's anything to clean up, man.
Well, the LLC is a wonderful way to start a business. It gives you a real opportunity to move ownership around in a fashion that's a lot simpler than an S Corp or a corporation. So that's the good news. The bad news is, if it's very successful, then all the income is earnings from self-employment, and the business owners are paying paying the Medicare tax on everything they earn. Now, when if they were to sell an LLC, then the gain would not be subject to the Medicare tax. It's still the sale of a business asset, but the LLC would be subject to more tax while they're in business. So the better opportunity is, one of the ways that we suggested is you start with the LLC format, and then upon some growth, you move it into an S Corp once there starts to be earnings. But in the early days, it's a lot easier to issue new stock, and there's benefits to the person that buys additional stock if you're trying to grow, where they can buy some goodwill and have some tax deductions, as opposed to just buying stock and just having basis in the stock. The 1202, I mean, a C Corp's got some great benefits now with 21% tax, especially if you're going to own it a long time. And then the 1202 benefit where you can sell it and not pay taxes on the gain in most situations. But you have to be a certain size for somebody to want to buy your stock. And that's really the problem. If it's a business that's going to sell for $10 million, you may not be able to sell stock. If it's a business that's going to sell for, $200 million, then there's a buyer out there that'll buy stock. Now, there's a cost to selling stock because the buyer doesn't get the tax deductions of goodwill and step up in basis on other assets. So there's no perfect answer, but it's something that should be looked into and considered.
Yeah, I concur, Herb. I mean, the thing is, a stock transaction is something that's hard to push down people's throat because they're buying the liabilities that are hanging out there as well. And, in a negotiation, obviously, it's not hypothetical at all. It's what the buyer and the seller, how they're going to react. So, there could be possibly sweeten the deal a little bit if they are buying the stock and have some tail insurance, to where the seller's not going to pay capital gains on the first $10 million. That could potentially be doable. And then, from a startup standpoint, I tell my clients that, the day that you start your business, build it to sell it. It's kind of like the E-Myth that was written, build it like a franchise organization to where you have all your processes, procedures, everything aligned. An LLC is a state registration. With that, you can be an S Corp, a C Corp, partnership disregarded. And Herb's correct on paying the taxes on the way, on the self-employment tax, on disregarded and partnership. And S Corp, of course, you can do the reasonable salary and not pay self-employment tax on the distributions. And, you've always got to look at double taxation. I mean, today you've got a 21% tax. We all believe that rate's going to go up, with the Democrats in office and just with COVID. I mean, there may have to be increases no matter who's in office, to cover this deficit that's been created on all the stimulus. So, double taxation is a real deal. I mean, you have a C Corp, they won't buy the stock, they have to buy the assets. Well, guess what? There's no such thing as capital gains inside of a C Corp. So you sell the assets and you got to get the money out of the C Corp. So, right now, even with 21% tax, you could even be looking at 41% tax on that transaction. Whereas if you're an S Corp, it's single taxation, runs through the K1, then a liquidating dividend. So, look at this thing, look at your vision, look at your horizon. Is it 5-10 years? And basically get a line to sell the thing. I mean, that's my thoughts.
It's interesting. One of the in the last year that I was in public accounting, I had a longtime client, and he had some foreign investors, and he had so he was familiar with C Corps and he was familiar with S Corps and partnerships, and he was the foreign investors were getting at the end of their were getting old, and he was getting old, and so everybody was thinking about what they were going to do after these particular ventures ended. They're real estate related ventures, and he made the decision that he was going to, with one of the operations that he was running that was going to make a lot of money, that he for which he had no partners, that he was going to turn it into a C Corp, and he was going to turn it into a C Corp because of the 21% tax rate. And we went through the issues, and we went through the how much time will you have if the Democrats take over Congress and presidency in 2020, 2021, how long will it be before they change the tax rates? And my comment was, Clinton got in and made it the tax his tax law is retroactive, they'll do the same thing. I mean, there's precedent for that. So you got to figure you'll pay a higher rate in 2021. But his idea was really interesting because what he was saying is he made the decision to keep it as a C corp because of how much money he was going to make during the period prior to 2021. Although there would be some in 2021, but he was going to make a significant amount of money, and the tax savings would be significant. He didn't have to have money taken out. And, it was then a matter of gifting to create a family asset or creating trust. And then he said, well, I'm already old. I'm a smoker. When I die, then they don't pay the capital gains. At that point, all of the value inside the corporation is going to be adjusted up. We had several conversations about it. So it was really interesting. It's a different way of thinking because of the circumstances. But he made that into a C. His company, it was an S corp. He made it into a C, and everything's moving forward the way he planned, pandemic or not. They've been selling the assets that they have, and it basically it's real estate development, home building lots and lots for commercial property, and it's going to all be sold this year in 2020, and he will have accomplished his goal. So it's interesting. It's always facts and circumstances, and that's really my point on this. But I've got to tell you, there's no perfect answer.
No, Herb, and that's why everything needs to be analyzed. I mean, typically you don't want to hold real estate in anything that files a corporate tax return if you have any desire to transfer that real estate out someday into a different entity or joint venture because of appreciation rules. I mean, you would actually pay tax on unrealized gains by transferring it out. So I think the point to be made here is, you really need to get with your advisor, and the tax laws are very complex, and some tax laws purely don't make sense. And it comes into effect when you sell your business because, it doesn't matter how much you sell it for. What matters is how much you keep.
Right.
And I mean, really, and when you get into the transaction and the asset allocation, and all of a sudden, the asset allocation is such you're going to pay ordinary tax rates on some of the assets. I mean, it can have a really large impact on your decision if you're actually going to go through with the transaction. So I think that needs to be looked at from a standpoint of seller's due diligence. That's one of the first things you look at the tax ramifications of your transaction, because everybody should have their number. This is how much I want to take home. Well, the tax will certainly affect that.
Hey, I think Jonathan had a question. I think I'm going to let him interject real quick. Jonathan, is your mic ready to go?
Can you hear me fine?
Yeah, we can hear you.
Excellent. So y'all brought up a scenario, if I thought right, and actually there's a scenario that someone I know is dealing with that I never thought of. So you say, let's say you have a business and you have partners in it, and obviously they have interest in it, but unfortunately, divorces happen. So then you might have a situation where a former spouse now has ownership interests, and that causes a burden to the business to operate fluidly. And you'll mention something about having a non-operating interest sell to operating interests. So that was a particular scenario that registered with me. It made sense that if you had, built-in controls or what have you prior to one of those situations happening, then you make a fluid transition. Hopefully I was able to explain that, or maybe you were remarking on something different, which, however you'd like to answer. Thank you.
Yeah. They didn't do their planning. It's already been done. they already have the problem. And the only way to solve that problem is with money. What I was talking about is they should have had a buy-sell agreement prior, when the business was put together. And the buy-sell agreement should have said, because I'm assuming the reason why the non-working spouse or the out spouse in this case owns an interest in the business is because it was community property. Well, Texas is a community property state. Entrepreneurs don't have anything, so everything, when they get started, so everything they have is community property. So the spouse owns half of it.
Yep.
But the spouse can sign her rights to that asset away as long as she gets a fair settlement of the entire marital estate when the divorce takes place. So to give you an example, the company's been successful and the business is worth $2 million and the family has, in addition to the $2 million and a house, they've got $1 million in other assets. Well, if they have this type of agreement, the working spouse or the spouse that works in the business gets the ownership amount, and the spouse that doesn't work in the business gets the $1 million of cash and securities, and it's been a fair split. But that has to be done in advance, because if it's not, then you've got a shareholder or an LLC owner or a member who wants to be involved in the business and may not be capable of being involved in the business, or is just not wanted in the business.
Herb, I think even on a larger scale, I got to tell you, and I'm sure Herb saw this as well, when people come in and they're having a bad divorce, even with a business partner, and they don't have a good operating agreement or company agreement. And that we talked about business startup and the last question, that is so very important. If you have, no matter who's involved in that organization when it's set up, you've got to have a solid company agreement, which is referred to as operating agreement in some states, to where you have all the provisions in it. You have everything from, the buy sell elements of it to drag along and tag along rights, who gets what. I mean, it's so very important that you do that on the front end. And Herb's correct, it's done. I mean, now you just got to deal with it. And we see that quite often.
Right. Yeah, it's a bad situation. And they're going to need somebody with a cool head that can explain to the former spouses the downside of fighting in the business, because it just makes less money. So, but that's outside of my role as an accountant and your role as an exit advisor. But they may ask you in, but it's the planning part that you really need to take care of.
Mm-hmm.
Okay, hopefully that answered your question. Speaking, good segue, by the way, because we're now talking about deal killers, and that's a company killer for sure. We won't get into I think we've beat it to death, but it's definitely a company killer. So we talked about it in the ready section, but in the aim section, you got to clean these things up. The bad tax positions, you just got to clean it up. If there's a captive insurance company that's involved in it, you need to get advice from a whole lot of players out there. But because I can tell you, the IRS had declared war on the captive insurance company. There could be some legal situations that could be out there, any kind of lawsuits that's out there that need to be cleaned up. Again, you want it to be as clean as possible for the buyer. Surprises, you really need to know your market. Something bad happens in the market while you're trying to sell the business, you can lose all your buyers. Family members need to be apprised. They need to know what's going on because, they may or may not continue. Customers, if they hear about it, they want to know that they're going to be taken care of. The worst thing that can happen to you is losing customers while you're in the sale process. Mm-hmm. or a theft. I mean, we were working on a transaction a number of years ago, and during the process, the owner uncovered a theft that he didn't know about that had been going on for years. Well, the buyer just said, "I'm not interested. I'm going to find a different business. You clean it up and maybe talk to me." Again, it's one of these things. Why do I want to get into a bad problem? Buying a business and making it successful is hard enough. Yeah. You don't want the added problems. And then what happens when you're ready to go to market and the seller says, "I'm really not ready to sell." Well, it's better to know early. And that's why you have to have all the conversations we talked in the ready part, and you have to try to clean up some of the deal killers, because that's a deal killer and it's a waste of time and energy. But then you'll also get, well, I know I don't need to sell, but I don't want to stop working. And, I talked about an ESOP, and that is one solution, but those are hard solutions because you can't guarantee post-transaction employment if you sold a controlling interest. You can, with an ESOP, sell a non-controlling interest and continue to run the business. So that's a way to do it. Who's more at risk, the buyer or the seller? Well, most people think it's the buyer because the buyer's going to transfer money and he's going to get the business, but it's really the seller. The selling process is very destabilizing. You've got a key employee group, and do you think they don't know? I did a lot of ESOP valuations, and I would do ESOP valuations for transactions, for the initial transaction, for example, when the business was going to be sold to the ESOP, and the owners don't want anybody. In most cases, they don't want anybody to know anything because it could be disruptive. So, we're walking through the factory, and who are we? Well, we were always insurance examiners. Well, don't I look like an insurance guy, right? Put a tie on and I look like an insurance guy. So we were always insurance people, and I'd go around and look at all the fire extinguishers. Well, I wasn't looking at fire extinguishers for real. I was trying to understand the business to try to put a value on it. But they always know. And they're going to feel, that's the destabilization. They're going to know. They don't know if they've got a position later. They need to think about it. Where do they want to be post-transaction? But you sure don't want them to leave, because if they leave, you've destabilized the business. And, some of them might be out there with a new company with some of your customers. So you really need to make it work. There's something that we worked with a number of years ago where we had that kind of situation, which was a stay bonus. In other words, key people, the business is going to sell at some point, right? And I'm ready to sell it now where I can watch over everybody and take care of it. I want you to help it happen. I know there's not a guarantee post-transaction for you, but the guarantee I'm going to give you is you stay through the end, and you stay a period of time after the end, and you get a bonus from me. Contractual, doesn't come from the company. You get that money. Maybe you get some at closing too. I mean, however you negotiate it, because you don't want them to leave. Do you want a position with the buyer? Well, positions with the buyer post-transaction are always at risk. There's no guarantees. Since I retired, we had one of these. Of course, they sold in October, and then COVID hit, and the buyer had to let a lot of people go, but they did terminate the contracts of the sellers. They were first to go because they were high priced. Got to have a good selling team. There's I know Gary's CPA. I don't know if y'all have attorneys in this group, but you need to know who is a good deal attorney. There's some people, there's some good lawyers out there. They're fine lawyers, but they don't know anything about taxes. And you best find out if they're going to be taking control of the tax situation, because I've seen transactions where nobody was watching the tax transaction. And it was lawsuits afterwards. Brokers, I think that's what y'all are taking that place, really, right? I guess you could be there if there's a broker there too, but there should be somebody that's looking out for, trying to get the deal closed. Financial planner, as we talked about, the key employee group that I just talked about, and maybe a banker, and maybe a coach if the seller may need a coach. He may have needed one before, but he certainly will need a coach now. Wished I had a coach for this retirement stuff. I don't like it. I needed to be better prepared, and I thought I was prepared. Nobody's ever prepared, I think. Anyway, so what are we trying to do? We're trying to make the buyer happy. As it says in the last bullet point, less risk to the buyer means more dollars to the seller. You got to have clean financial statements, accrual-based, good monthly financial statements, clean receivables, no litigation. Or, if you're a Walmart, you got tons of litigation, but no serious litigation. Company appearance, you got to paint the house, got to make it look good. I've got a former client who I've remained friends with, and he does not have financial statements. He does not have books that make sense. We just did a tax return, and this company was good years ago when his dad owned it, but he took it over. Company appearance is horrible. And I keep telling him, if you want to use a rule of thumb, the business is going to sell for 4 to 6 times its cash flow. Yours isn't going to sell for 3. It'll be under 3. You got nothing to look. It's too much risk. They don't know what your numbers really mean. Too much risk for them. You're not going to get much money. You need to clean it up. He's going to clean it up next year. I've heard that for a number of years, by the way. Okay, we've gotten through the aiming part. Now we're ready to fire. You're ready to market the business. So there's a difference between price and value. On the small side, businesses under, say, $20 million, generally brokers are going to say, what do you want? And I think your company is worth X dollars. But when you get over a certain level, the people that represent sellers put a package together and send it out without a price. And they're hoping to get an auction that creates a bigger price. How you do that with a smaller company, I don't know. I've not been in the business of marketing businesses, but I suspect you can do it. Price and terms. Sometimes it's not the price, it's the terms. We worked on a transaction that almost didn't go through, and basically, and it had to do, interestingly, it had to do with contingent payments. I mean, the money was the seller could have retired for 3 or 4 lifetimes with the money he was getting at closing, but he had contingent payments too. And we just changed the terms. We changed the period of time that he got it and lowered the amount so they would have less cost each year. And we were able to put the deal through. And it was a good sale for the seller. And he agreed afterwards. He even has talked about it when he buys me lunch. Unfortunately, I didn't get part of it, but I do get lunch occasionally. And he says that, he reminds me that I said, you don't sell now, you may get nothing. By the way, it was 2012, and he wanted to sell before the tax rates went up. And it was oil field service. I mean, why would you ever wait when oil field service is, when oil is expensive? Sell your business when oil's high, because tomorrow it's going to be soft. It's going to be low. You got to qualify buyers, because you're going to show the buyers all of your information. Yes, you're going to have a non-disclosure agreement. Yes, they'll agree to that. But, there's some people that that I don't trust, and I wouldn't let them in. Somebody's got to qualify the buyers. You got to know that they're not just on a fishing expedition, that they can sell. I had a longtime client that had some interest, and they went on the market, and the broker convinced them that their sale price had to have a 2 in front of it. That would be 200 million plus. And they didn't have offers on 200 million plus, but he had a buyer. You know what the buyer didn't have? Money. And they didn't sell. And then it's oilfield service. What happened to oilfield service as 2019 came 2020? Oil prices kept dropping. It's still owned by the sellers, or by the people that owned it to begin with. Just didn't have a transaction. And now I'm sure their number's not 100 million. So you got to have, somebody's got to qualify the buyers. Don't be trying to do a transaction with somebody that can't buy you. You'll have documents to protect yourself, but whatever you'll be giving financial statements, you'll be giving them all sorts of information, and some of them could be your competitors. So you need to be careful in qualifying the buyers and making sure you're protected when you give private information, confidential information. So what happens? The deal proposals, you get a letter of intent. Generally, it's not binding, or you want it to be not binding. If you don't have a good lawyer, you might bind yourself to a contract. So make sure that you have a contract with a good attorney. That's part of your team, right? There's due diligence. Somebody's got to lead the due diligence, and somebody's got to be in charge of that team that leads the due diligence. There's going to be representations and warranties in the transaction that you've guaranteed that you'll do certain things. What's come up recently in bigger transactions, and I don't know where the level hits, but transactions probably over 20 or 30 million dollars, where you can actually get insurance on the representations and warranties. And an insurance third party will satisfy the claims to the buyer, so the buyer doesn't have a problem. It just makes it smoother, but it costs money, and you're not going to get insurance if you're not clean. So, deal conclusion, there's going to be holdbacks. Generally, transactions today are a price that the value is determined on a non-cash, non-debt basis, meaning the seller keeps the cash at transaction date, the seller pays all the debt, and the buyer gets the working capital and the assets and the operating assets. If there's generally a peg, there's an amount that's considered in for working capital. Working capital is $30 million, for example, or $2 million, whatever it is. There's a settlement, and there's a holdback to cover the settlement. So if it's a $5 million working capital you're supposed to have, then 3 months later or 6 months later, you have a settlement date, and you have to deliver that $5 million. If you're short, they take some of that money back. If you're at 5 million, you get all the money, and if it's greater, you get a little bit more money. There's contingent payments. Somebody's got to look at those and have a process for following to get your money. Potentially continued employment, but I've already talked about that. And the last thing is, to the extent you're taking a note back, will you collect it? I think that's really part of qualifying the buyer. There's a good chance you're going to have to be a co-investor with the buyer, depending on the size of the transaction.
Mm-hmm.
So, come to the end. time for questions. If there's any other questions, I'm happy to answer them.
Yeah, it looks like Abraham had another question about C Corps and the stock there. So he said, if I'm a stockholder of a C Corp and the company is acquired by another company, will double taxation happen? And then elaborating on that is, if he is the stockholder and sells his stock and the money comes to him directly, will he have to pay capital gains tax without C Corp paying the taxes?
So the answer is if he's selling his stock, then the buyer is buying stock, the stock of the selling business, then he has one tax. If the buyer is buying the assets of the business and the corporation is liquidating the business afterwards, then he's getting post-tax. His liquidation is after taxes were paid inside the C corporation. So now that's the correct answer, but it's not the accurate answer. Because if you're a C Corp and the going concern business is worth $10 million, let's say, if they were buying assets and the buyer is buying stock, the buyer may not be willing to pay $10 million for the stock. Because if the buyer is buying assets, let's say that the assets of the business are $5 million and they're buying $5 million worth of goodwill. If they're buying assets, they can amortize that goodwill over 15 years and get tax deductions that saves them money. That has value. If they don't get that benefit, they may say, we're only willing to pay $9.5 million, whatever the number is. So now, if he's a shareholder, a minority shareholder, he's not going to be privy to any of that, but he'll get what he gets. But he would get less in that circumstance than he would if it was an asset sale.
Perfect. Any other questions before we wrap up? I'll give folks a minute or two to chime up any questions if they have them. In the meantime, Herb, thank you. This was great. Very comprehensive and really enjoyed having you today.
Thanks. I enjoyed being here. My only problem is, Gary, you owe me lunch. I mean, this is a lunch seminar and I got nothing to eat.
That's the benefits from work from home, I guess. You can go eat whenever and whatever.
We should have sent you a lunch, man.
That's okay.
Well, Herb, thank you so much. Real quick, next week, for those who would like to continue joining us at the same time, we've got another series. It's actually going to be one of my college roommates who now is a M&A attorney out of Maryland, but he's going to be discussing with his partner how small businesses can take on growth capital, usually in the form of private equity or family office financing, without running the risk of being diluted and still effectively maintaining control. So there'll be a lot of ins and outs. That's kind of the general theme, but should be a really interesting topic, something new to the scene that we've had. That we haven't had in the past week. So really looking forward to that. And Herb, thank you again for today. Any closing remarks?
No, I appreciate the opportunity to be here and happy to answer questions and happy to help out.
Great. Well, we'll see everybody next week.
Okay. Thank you.
Same time, same place. Bye-bye.
Okay.